It was a dramatic day on the stock market today. The S&P 500 index fell 6.6%, the most since the financial crisis. It was the first session that investors could react to the decision by S&P to downgrade US long-term debt. But most of all, it reflected this big concern about global growth and that the US and other countries may be heading towards another recession. The big fear now is this will be a blow to confidence, and it'll be self-reinforcing, and that now consumers and households and companies will begin to retrench and have a real negative effect on the economy. At the start of the day, stocks began to sell in Asia. This moved on to Europe, where the European Central Bank intervened aggressively to try and support the markets of Spain and Italy. Even then, stock markets fell heavily, particularly in Germany. Then when trading started in the United States, stocks fell and fell again and ended the day 6.6% lower.
The market reaction was in some sense an overreaction because it didn't happen by itself. It happened following a string of very disappointing economic reports. So people are selling today not just because of the downgrade, but because the U.S. economy looks a lot less promising today than it did 1 week ago or 3 weeks ago.
Also in the United States, so far there has been no sign that there's been a banking crisis as there was in 2008. But today, for the first time, there were some signs of distress amongst American banks, and stock prices of banks like Bank of America fell quite heavily. Banks sit at the heart of the economy, are the sort of plumbing of the economy. And any signs of distress there might give us broader clues about the true health and the true problems across the economy. There's now the question about how policymakers will react. And tomorrow the Fed's Open Market Committee meets, and there are questions about whether it will take steps to perhaps ease financial conditions. It probably won't restart quantitative easing, but it may take steps to ease lending to the banking system. I'm Bowley for the New York Times.